What you're telling me is that music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism. 1974, 1987, 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves.
I say when we sell. Hey, I say when we sell.
We are living through a 1 in 100 year global monetary reset. We sat down with Luke Gromen this week. I've been a fan of Luke for a long time, so really enjoyed this episode, and I'm sure you will as well. We discussed how the United States, China, and other major players are positioned for this reset, talked about gold and Bitcoin and stablecoins, the role in this reset as well, and ultimately why everyone should own gold, everyone should own Bitcoin, because if you're going to inflate the debt away, you need to own hard assets to preserve your wealth, to participate in the economy. And so if you already own Bitcoin or you want to purchase Bitcoin, reach out to OnRamp. We help investors like you, whether you're an individual, a business, an institutional investor, secure Bitcoin for the long haul. A lot of our clients already own Bitcoin. Some are just stepping in for the first time, but we are talking inheritance, insurance, Bitcoin-backed loans, trusts, you name it. We're really a one-stop shop for everything that you would need for your Bitcoin. So head on over to onrampbitcoin.com, book a consultation. I would love to meet you if you're a listener of the show. So yeah, let's have a conversation, reach out. We'd love to hear what you're enjoying about the show, what we could improve, and of course, talk about your Bitcoin journey and how we could potentially help here at OnRamp. Hope you enjoyed this one. All right, we are live. It's the last trade. This is a special edition. We have Luke Gromen joining us, joined by my co-hosts as well, Brian and Michael. Luke knows, but I'll say it on air. I'm a big fan of your work, Luke. I've been a subscriber of FFTT for, I think, 4 years, I want to say. Maybe shortly after I discovered you in 2020, so it could be 5. But that point aside, I think you do a great work. You're one of the best macro analysts out there. So anyone who's not familiar with Luke's work, certainly check out his X account, check out his research after this conversation today. And I want to call out as well, if you are tired of me recording from my grandmother's attic, give us a like and a comment on the YouTube video here. I might be able to upgrade my podcast studio in the next few weeks. So, Luke, great to see you. How are you doing?
I'm doing great, Jackson. How about yourself?
I'm having fun as always. Yeah,
Luke,
thanks for joining us.
Jackson's our weekly insight into current macro trends as millennials and Gen Z struggle to find a home, buy a house. So we hear weekly or every other week we'll hear about him getting priced out by boomers, not being able to afford a home in the Philly area. So that was his plug to share that his struggle is real.
That's right. Yeah, it's I sympathize.
That's right. For now, to quote President Donald Trump, I'll have fun playing with my Bitcoin. But we'll get to the home ownership at some point. So Luke, want to be respectful of your time. Thanks again for joining us. I think an interesting place for us to start is just to comment on where gold currently is as the market price of gold and Bitcoin as well. I would love to hear your thoughts on just what the market is telling us. I did see something 2 weeks ago. This is the first time ever where gold and Bitcoin were the number 1 and number 2 year-to-date performers. So interesting data point there. What do you make of that?
I think for gold, I think it's a trade where all roads lead to gold. Like pretty much anything that can happen, I think is good for gold. And I think ultimately it's good for Bitcoin, but Bitcoin still trades with a risk-off component to it, as people have talked about, vis-a-vis NASDAQ and what have you, stocks more broadly. But gold seems to be kind of a winner no matter what happens. Rates go up, we get a fiscal crisis, which may be partly contributing to the breakout today. Good for gold. Rates go down aggressively, real rates go negative. Good for gold. We get a trade deal, or we don't get a trade deal. We saw that with Liberation Day. Good for gold. We get war. Good for gold. We get peace. Increasingly, it looks like the peace is going to be dictated, at least in part, by the BRICS. That's probably good for gold. Any peace dictated by BRICS rather than by the U.S. And so you kind of look around and just go, all roads lead to gold. That makes sense to me. From a Bitcoin standpoint, I think it's kind of the same thing. Like I said, Bitcoin does have a bit more of a drag with what risk assets are doing in the short run. But ultimately, I think the reason why both have done so well year to date is neutral reserve assets. All of a sudden, long-term sovereign bonds are no longer risk-free on a real basis. And that's something that is, the math has been crystal clear for 10 plus years. But I think just in recent years, and then overlaying the geopolitics on top of that post 2022 with the Russian FX reserve sanctions, all of a sudden people are thinking about, and maybe even layering in the nationalization and Trump and tariffs and stuff, like, do I actually hold what I own? And is it actually inflation proof? And, there's really only two assets, in my view, that do a really good job of that as a neutral reserve asset: Energy Link, supportable, et cetera, et cetera, et cetera. And it's gold and Bitcoin. And so it makes sense to me that those two are leading, or, top of the leaderboard year to date.
Yeah, it makes a ton of sense, Luke. One thing that you referenced in there was 22, when Russia's treasuries were seized. I think that's it feels like a long time ago at this point, but in the grand scheme of monetary history, it's pretty recent. And at that time, Zoltan Pozsar from Credit Suisse put out a fantastic report, which you were all over at the time. And I think a lot of his ideas, you had actually been saying for years prior to that. But I'm curious, what are your thoughts on his thesis around really Bretton Woods III, this move towards forms of outside money, namely gold and Bitcoin, versus inside money, and sort of 3 or so years after that, how do you think that thesis has played out? Because in my mind, he was spot on with sort of forecasting what was about to happen in the next few years. And so where are we in that thesis? What inning are we in terms of that really playing out in your mind?
Yeah, I mean, shortly thereafter, I think I said to someone, I think this might be come to be seen every bit as big as Nixon closing the gold window in 71. And yeah, I think it's played out quite well. Central banks have bought on average, I want to say 1,000 or 1,100 tons of gold a year every year since. Gold is now the second biggest reserve asset that just surpassed euros. Another probably, 2 years of decent price appreciation and 1,000 tons a year, and gold will be the number one reserve asset, surpassing the dollar and treasuries. And so to me, there's an absolute sea change going on since that happened, being driven by realpolitik, which is, I heard from multiple different people that don't know each other, that major Persian Gulf nations were quote unquote, scared, basically scared to death, petrified, I think was the word, by that seizure of FX reserves. And so regardless of how you feel about the actual seizure itself, it happened and there was a reaction, and that reaction makes perfect sense. And I don't think you can put the genie back in the bottle as it relates to that. Everyone has seen that. And so I think that's done. In other words, going forward, you're going to have a neutral FX reserve asset, and that's gold. And I think on some level it can be Bitcoin. We've seen some marginal sovereign wealth fund type buying out of the Gulf. I think Abu Dhabi late last year, but that's been about it. It could hold that or complement gold in that role, but we've not really seen it yet. But I think that's like I said, I think that was the 1971 moment in the other direction. That was, we're going back to a system with a neutral reserve asset that floats in all currencies. And that then has just absolutely enormous implications for the global macro and global financial system, because what it implies is that currencies are going to trade more on balance of payments. And so the nations that run big deficits are going to have weaker currencies, and the nations that run big surpluses are going to strengthen relative to those that run big deficits. And that was sort of how it had always worked, kind of, except for the dollar. The dollar ran the biggest deficit, but was still the cleanest dirty dirt, or the cleanest dirty shirt. And I think we're the worst performance in the dollar in 50 years to start this year. I think might be a warm up to sort of the dollar getting marked to its balance of payments fundamentals.
Yeah, it's a great outline. It's something I'm curious how you reconcile, and also maybe sharing a little bit of monetary history, specifically after '08. I think one of the best podcasts you've done, at least that I've listened to, was with Robert Breedlove. We actually did a recap on it. I think it was about 2.5 hours, but really broke down a lot of these concepts. And one of them, it reminds me when you were speaking a little bit of Tether, and it's not widely known, and I can't prove it, but it's I think widely understood in this industry that Tether is depegged multiple times from the dollar. But the exchanges were incentivized to not do anything about it because it is the trading pair for BTC. So everyone waits to reshore up and then, keep at par with the dollar. So everyone, you don't have like a basically just kind of like fleeing of assets. And what that reminds me of is that's a small microcosm of a larger global environment. It kind of, I think about it in this same sense with assets, insolvencies, counterparty risk, is there's just an unwinding that's going to take very long. And there's, to your point, you've been looking at this much longer than we have. It's like point blank, you want hard assets, gold and Bitcoin. But we live in this world today where the 60-40, like we're still looked at as insane people. When you think about even the Paul Tudor Joneses of the world that are gold and Bitcoin are taboo. How do you get exposure? Up until recently, it was GLD and these ETFs. I'm fairly confident you don't hold a large position in ETF. You probably understand why you would want spot. But that's where the market's going to, get cattle herded into because that's just what they know, equity-like exposure. And so there's just still such a long learning of, to your point, FX and trade was net settled, but we went away from that on this dollar standard. And so we're in a multi-decade process of just relearning what money is and what assets are. Just curious how you think about where we're at and how this started much longer than this past few years, even with the FX, the Russia seizing of treasury reserves.
Yeah, I think we're in two pitches into the first inning to what is a probably once in 100-year monetary system change. And I think it's gonna impact sort of everything around us. There was I don't know if it was a hot mic or intended to be heard, but Putin and Xi in early 23, as Xi was leaving Moscow, said, look, we're making changes to the system not seen in 100 years, and we're driving these changes. And to me, I thought that was a really important comment, because 100 years prior was 1922, roughly, which was the Genoa Conference of 1922, which historians and macro people far greater than me point to as arguably the original sin to sort of this present dollar system, which that was when it was decided that gold, that the dollar and the British pound would be made on par with gold as an FX reserve. And that basically made the dollar and pound as good as gold and everything else less. And that kind of kicked off this whole dynamic of, paper is as good as gold. And as soon as you do that, where you don't have to settle imbalances in gold, in physical specie, those imbalances are allowed to grow and grow and grow. And there's a winner and there's a loser, and there's political reasons that those choices were made. And I think part of it was allowed to continue post World War II because the choice was pretty simple. The world was trashed except for the U.S. And so the U.S. had all this industry and no customers, and the rest of the world had nothing, of certainly the industrialized world. And the choice was okay, either we live hand to mouth for the next 60 years, or we basically create a system for a period of time where debt becomes an asset, and in a very widespread manner, as a way to basically pull forward from the future, rebuild the centuries of capital that was destroyed from 1914 through 1945 in two world wars. And politically, there was really no choice, right? Once people start to starve and live hand to mouth, they're going to vote for really bad people again, and you're just going to go right back to where you started from. So the decision was made at a very high level to basically have this system as we had out of World War II, which was, the dollar at the center of it, dollar pegged to gold, everything else around the dollar. And that was done for very real politic reasons, which was just the choice is everybody lives in caves and rebuilds hand to mouth basically after World War II. And we rebuild over 60 years, and everyone's quality of standard of living sucks for 60 years, and we have another depression for another 60 years. Or we can rebuild really aggressively by sort of stockpiling debt as reserve assets, and that's the choice that was understandably made. The part that I feel like most, even senior market participants, many don't recognize is A, that this was a decision that was understood and made, and B, that there was a follow-on to that, which was it was always understood that at some point they were going to have to go back to a neutral reserve asset, a gold, presumably, type of system, or a Bancor type of neutral reserve asset, as Keynes talked about it at Bretton Woods. So, it's one of these huge changes where I think we are now in sort of two pitches into the first inning of going back. We have now reached the point. We can see it in the debt, we can see it in the deficits, we can see it in the geopolitics, we can see it in the imbalances that are just so far beyond anything anyone ever imagined or intended. Like, we've got to go back to what they always knew they were going to have to go back to, which was a neutral reserve asset that settles trade and that floats in all currencies. And so I think we're in very early stage of that. I think there is some disagreement around that. I think much of the global South wants gold. I think the United States has started to stand up Bitcoin essentially through the stablecoin initiatives, in particular, to perhaps compete with this or offer an alternative. We'll see. But to me, the imbalances are so massive and it's so early on. I don't think people have, as this 100-year original error and then understandable political decision post World War II was made and needs to now be unwound, exactly what that implies for the international trade value of the dollar, for the price of gold, the price of Bitcoin, different asset classes, for what happens to the real value of bonds. There's just so many things it potentially impacts.
Yeah, incredibly well said. Appreciate you walking us through that, Luke. I would love to hear your thoughts on where we go from here in terms of neutral reserve assets. I had some notes down. I think it's fascinating, and I don't know how to quite parse this myself, because you've covered extensively how China, Russia, BRICS nations have been accumulating gold at quite a rapid clip the past decade. You just mentioned earlier this show that gold is now the second largest reserve asset globally. And I've always tried to think through are the BRICS nations, or is China, if we focus China specifically, are they at more of an advantage than the United States is as relates to gold as a neutral reserve asset? And there is a second part of that question on Bitcoin and stablecoins, but I think I would love to just understand and pick your brain on the gold aspect first. Like, how do you weigh how China and U.S. are as it relates to just gold reserves, and also the mechanics of revaluing the gold, not only in terms of how that works. I know it's kind of like an accounting thing, but what would that signal to the market if the United States revalued gold on their books?
Well, I think if the U.S., they'll take the shorter one first. I think if the U.S. did revalue it just with the accounting move, I think it would signal that the U.S. is on board with gold being moved back into the system as a neutral reserve asset, fully on board. And sort of, I think it would be bullish for gold. I don't know that we'd wake up and gold would be up, $1,000 or something, but I think it would be very bullish for gold over the ensuing, however many, over the coming quarters and years. As it relates to China vis-a-vis gold, it's kind of a two sides of the same coin type of question, because I do believe there are interests in the U.S. government and intelligence world that see that if gold prices went much higher as part of a reset of a system where gold is the neutral reserve asset, that it might benefit the Chinese and the Russians to the detriment of others, particularly given in-ground reserves. If the Chinese and the Russians have more in-ground reserves of the neutral reserve asset, then that is an advantage, relative to what they may have in vaults. And I think there's some validity to that objection. the flip side to it is the U.S. spends most of its interactions with China telling the Chinese they need to consume more of their own production. And the Chinese government has been, paradoxically, the communists have been telling their people for 25 years to buy more gold, buy gold, buy gold, buy gold, buy gold, buy gold, which is a very non-authoritarian, decentralized, freedom-loving thing to do, which is why I say it's paradoxical. And so point being is that I think the grand bargain to be had on the table is, look, the U.S. needs to weaken the dollar. The U.S. wants the yuan stronger against the dollar, and the U.S. wants China to consume more of their own production. And as you go down that list of three, the price of gold's a lot higher. It's like check, check, check. It takes care of all three. You can recap Chinese consumer balance sheets. They will have a lot more money to spend on their own production if the price of gold goes up a lot. You will have a weaker dollar. And I forget what the third one I just said was, but the gist of it is that the price of gold going up a lot helps all three of those things. So there's sort of two sides of the house. I think from a grand deal to be had within sort of a reset, I think it is in the U.S.'s interest for the price of gold sitting in China to go up a lot. But it's not in the U.S.'s interest, arguably, for the price of gold in the ground in China and in Russia to go up a lot. So, it's kind of one of these, the U.S. needs to decide what it wants, because ultimately China's happy to keep buying gold here because they know relative to U.S. debt, it's still wildly undervalued. So they'll happily just keep piling it on regardless.
Yeah. I mean, it sounds like the natural paradox of a neutral currency. It benefits everyone. Luke, I followed you for a while. I think when you first initially, kind of at least in the Bitcoin scene, came on, at least from my remembering, was with Marty, who's a good friend. And this was years ago. And it's been, I think, to Jackson's point earlier, one of the clearest, best thinkers in this space helps because you don't necessarily come from the Bitcoin world, which usually helps because you look at it from a broader view than a singular asset, and also what it fits into just a traditional market construct. And it feels like over the past few years, you kind of grow to realize that Bitcoin may play a larger role in global macro and also in your personal portfolio. Just curious how that's shaped and how you see that playing through this, because I think the beauty and what we're trying to do a little bit more of is kind of isolate Bitcoin to be closer to gold than it is to crypto, right? This notion of proof of work, sovereign currency, neutral currency, it benefits if you're able to isolate it, because it feels like for most retail investors, the path to understanding Bitcoin has been historically through gold. But very similar with gold's appreciation and people understanding why it's appreciating and its value as a neutral asset, well, you can't help but also start to see and understand Bitcoin's value prop, given that it kind of like gold with wings effectively, right? So just curious how you've been thinking about that and how you see that playing out as investors naturally start to go to gold. They will be more open theoretically to Bitcoin when in a world where they would have never gone to a sound money because of cash flows and all the other associated things that a normal traditional financial investor would not be interested in.
Yeah, I first bought Bitcoin right shortly after Coinbase launched, right? So 2013. So I owned Bitcoin, and I was on this, this is in a prior life. I hadn't formed FFTT yet. But I was on there with another partner of mine who was in institutional equity sales. And we each bought a slug of Bitcoin, and we're like, hey, let's, I can still find the receipts on my Coinbase account from 2013. It's like, I sent 10 Bitcoin over to John, and John sent 10 Bitcoin back. And hey, this is so cool. It cleared, and, sort of like, wow. And now you're like, oh my God, we were sending $1.2 million a rattle. Wow. Wish I'd have known that. So obviously, I don't know anybody says, boy, I bought enough Bitcoin back in 2013. As I definitely did not. But I always kept it around that whole time, even after I started FFTT, and even after it had gone from whatever. I think I probably bought it from like $600 to like $1,300, and then it went like back to $500 or something, and I just held it there. because it's kind of one of those things where if you have just a stub of something, you still pay a little bit of attention to it. And I just felt like I wanted to pay attention to it. And then in 2017, when it ran to whatever 17,000 and split from Bitcoin Cash, so now I've got and this other stub in there, and I've got Bitcoin, and that forced me to pay attention because all of a sudden it was like, oh my gosh, like this is like found money, and it's like actually real money. I should probably know something about this, and so I started kind of digging it again. But again, to me, it felt like a bubble. Like it felt like every other bubble I'd seen in my career, where it sort of, and when in early 18, I mean, you can still find the old tweets that I put out there, just, to heads up the Bitcoin people, like, look, they're bringing up these derivatives. That was when they were launching, I think, Bitcoin futures, like in the first quarter 18 or something. And I don't even know if they ever did a whole bunch of volume in them. But my point in those tweets was like, look, this is how they've worked to contain gold all these years. This is why gold isn't 10,000 an ounce, is because, you've got all these unallocated paper derivatives. So just, be aware, because a lot of the Bitcoin community was super excited that, hey, this means institutional exposure, blah, blah, blah. And I'm like, well, it might not be good for it. And whether it was the futures or whether it was just the natural 4-year cycle, I don't know. But Bitcoin then proceeded to kind of do what it does. And so to me, that validated, okay, well, this was just a bubble and whatever. I can forget about this thing again and I'll just leave it here. Because I'll be honest, it was in 17, it was really giving me a really hard time mentally from the standpoint of as I'm watching it go to 17,000, and I had a tiny Bitcoin position and a big gold position. And I was like, oh my God, I'm wrong for the right reason. Like I was right about what was going to happen and I'm on the wrong horse. And then they did the futures and it fell down. I was like, oh, okay, right? It's like, okay, my priors have been confirmed. I'm good to go. Gold was the right one. Bitcoin was just a one-time bubble. We got all excited. Okay. And that was about when I think some of the Bitcoin community, maybe 2019 into 2020, started reaching out to me and having me on some podcasts, Peter McCormick and some other guys. And I give them a ton of credit because they sort of dragged me into it kicking and screaming. Because I was still at that point, I was like, well, like it's kind of interesting, but I think it's just a bubble. Like it did its thing and now it's back. And, their overriding point was just, Luke, you come at it from this macro, like you were saying, Michael, and like you're running the ball to the 1 yard line going in. Like all you got to do is like say hike one more time and like step over the goal line and you'll get it. And like, so they were just, and thank God that, as you guys know, the Bitcoin community is very, optimistic and uplifting and enjoyable to be around, generally speaking. And
persistent.
Yeah, and persistent. And so they're like, and to my credit, I wasn't a dick. I could have been like, piss off and like they probably would have said, well, F you. But I didn't. I'm like, okay, all right. Like I never said no. And so finally, like where it really hit big for me, finally, where I went from like, this is interesting to like, oh my gosh, was in, I guess it would have been like November of 2020. If you remember, Bitcoin went back over like $20,000 with authority. It was like, whoom, through it. And I looked at my wife and I just said, look, I'm wrong. Like this is not a bubble that went up, because every other bubble in my career was, up, crash, and it's dead for like 5 to 10 years. And yet here I am 3 years later, not even, 2.5 years later, and this thing's breaking through the prior highs with authority. And I looked at her, I said, this is a currency issue. This is like, if I look at the chart of Bitcoin in dollars, it looks like the chart of, Turkish lira in dollars. It looks like, Lebanese pounds in dollars. It looks like a hyperinflating currency. It looks like a currency crisis and a weak currency in dollars, except this is dollars and Bitcoin in dollars. And I said, look, this is gonna be a big position for us, because like, I'm wrong. Like I thought and it's not. This is not a bubble. This is. I started calling it the last functioning smoke detector. Like this is what gold. It's actually what one of the biggest physical gold traders in the world told me a couple of years earlier. It's like Bitcoin is doing what gold would be doing if it didn't have the gigantic unallocated gold market attached to it. And I'm like, okay, here we go. And so. I actually shifted a bunch of gold into Bitcoin, and then I actually backfilled the gold that I had shifted into back Bitcoin, and then I kept adding to Bitcoin. And so for me, it is now, I think, and then once you have a good position, then you really got to learn everything you can about it. And the more you learn about it, the better you feel about holding it. I mean, volatility aside, you sort of learn that, but like the more you learn about it and the more you get involved in the community and the more you realize, like, wow, this really is the last functioning smoke detector around what we're doing. And, I want to be there. And so it was really kind of a fun process through all of that. I mean, I wish I would have gotten to the 2020 point in 2013 because I'd probably be on a beach somewhere having flown there on my own jet, but that's neither here nor there.
I love it. It's an incredible anecdote, and it's a signs of obviously a great investor and somebody that's just has the self awareness, because most people have the sunk cost fallacy and just double down on kind of their priors. And it reminds me of similar that doesn't get talked about enough, but Paul Tudor Jones' journey, because if you remember, I think it was after the 2017 bubble, he referenced having his analysts do diligence, and he looked at the supply, and it was like 85% of the same holders watched it crawl down to $3,000. And he's like, nobody does that. Like, nobody still holds. And he's like, what are we missing here? And then the other thing is, it probably helped the Lynn Aldens and other individuals coming in from the macro space to help in, like, because it helps to see other intelligent people follow the trade versus the persistent lunatics screaming at you on Twitter as well.
Absolutely. I mean, I know Lynn, she's a friend of mine. And so it's really helpful to be like, it's a true luxury and privilege to be able to, like, bounce stuff off or be like, hey, I don't understand this. Help me understand this. And she's got this great, way of breaking things down like an engineer. Like, no, think of it this way. And then I'm like, oh, okay, got it. And once you have that understanding, that leads to what Paul Tudor Jones discovered, right? Of why weren't people selling? Because they knew. Like, once you know, like, you don't sell unless you really have to.
Yeah, that's a really fascinating sort of peek into your journey, Luke. I think one thing that stuck out to me there was your, I guess, initial curiosity to get some in 2013 is actually super critical to the rest of your journey, because in my mind, most of the people in traditional finance, they don't have enough curiosity to do the initial allocation, and then they don't watch it like you watched it. So having that initial allocation made you continue to at least think about it in the back of your head, and actually in the future be willing to say, what if I was initially wrong about this thing? Because that's the recurring pattern with a lot of more traditional finance, hedge fund types. The most recent example is Philippe Lafont from Coatue, who talks about his journey, and he initially just dismissed it for many years and ultimately woke up and realized, like, I have to be willing to question if I was wrong about this thing. And that's almost, that's one of the greatest skills of the best investors of all time, is being willing to say, what if I was wrong about this? But I think the sort of the initial allocation is actually critical in that, because then you're more predisposed to say, well, at least I got some back then, and so I'm not going to be as biased against this being not originally what I thought it was.
Yeah, and I had some advantages in that, I was work on the sell side, calling on big institutions, and a very dear friend of mine was working at one of the biggest hedge funds in the world. He had a couple of friends that he introduced me to, call it, I don't know, probably 2009 or 10. And they were both played minor roles. They're both mentioned in passing in The Big Short, but they had made good money in The Big Short, right? The mortgage derivative trade. And what these two guys were doing was they were buying Bitcoin in like 2010, 2011, right? And so people say, oh, if I could have bought it in 11 for whatever they were buying it for, $1, $20, $100, gosh. And like, it's easy to say, but like these guys were like flying down to like Ecuador and like buying Bitcoin from like video gamers. It's like, it was the wild friggin' West. And so they were kind of going around. And so they were the ones that really, like 10, 11, were starting to tell me about it. And they were the ones, finally, like by 2013, I said, all right, I want to own some. How do I do it? And they're like, here, go to Coinbase, download it on your phone, away you go. And I doubt I would have ever done it if not for that. But I will say one thing as an investor, I've always had an ability to do for whatever reason. It's like when I'm wrong, like I can just flip. And it's just like, it is almost like, it just completely ownership gone with, oh, I'm wrong, move on, wipe the slate, like go forward. So luckily it played out well this time.
One thing that's really crazy to me still is that Bitcoin is 100K, and yet most people don't care. Maybe I was the crazy one for thinking that 100K was going to be a psychological barrier, was going to get a lot of press, a lot of attention. And here I am. My family, my friends, they still think I'm this crazy guy who's buying this magic internet money. But one day I think we're going to be onto something here. And if we are, that's a good thing for a number of reasons. But it's also a bad thing because you can imagine right now there's not that much awareness around 100K Bitcoin. Yet there's still been hundreds of billions of dollars of losses. There's still billions that are hacked and social engineered out of people's accounts every year. There are more and more kidnappings happening, not only of high profile people in the industry, but also of everyday people as well. And so unfortunately, this is going to get worse. I mean, there's really no arguing that as Bitcoin continues to appreciate and people with bad intentions recognize that a lot of Bitcoin sits in people's homes or nearby, this is going to get worse, or people recognize that it sits on exchanges with very weak authentication points. Again, lots of threat vectors typically for people's Bitcoin. And so at OnRamp, always looking to stay ahead of the curve. And part of that effort is launching OnRamp Guardian. It's included with your OnRamp account. And it really, in a number of ways, protects against digital and physical threats. So if you want to learn more about it, just reach out to us, or you can check out our website, onrampbitcoin.com, and schedule a consultation. It's always funny to hear when people say, oh, if I'd known about it then, I would have bought it, right? Because even to this day, with the ETFs just going live in 2024, everyone effectively, not everyone, but 99% of the people, or let's say investors in the US, could easily have made an excuse, well, if I'd known about it, I would have bought it. But they did know about it, they didn't buy it, and now only starting to buy it, very, very small percentages. It's still a retail-driven market because the ETFs are allowing for that liquidity access, right? Very, very few investors have actually gone into like Bitcoin native rails and purchased Bitcoin, let alone flown to South America and done a cash deal for 10,000, 100,000 Bitcoin, right? So I always find that fascinating. Luke, Brian and I both are from the traditional finance world, and I actually remember in 2020, after I was living in New York at the time, after everything shut down in the city, my dad had to drive up on St. Patrick's Day actually to evacuate me out of the city. Normally the craziest time in the city, like St. Patrick's Day, is probably one of the busiest times in the city. Not a soul on the streets. Anyways, I get back to Pennsylvania, and it took me having to go look into like macro voices, right, to find some of these like more off the beaten path or esoteric interview podcasts, and that's how I found you. That's how I found Brent Johnson, Lynn, a lot of the great macro thinkers that I think do a phenomenal job. But when I got back to the office and I had this different view back in 2021, it was remarkable that nobody in my office, I'll put Bitcoin aside, but even gold, right? Even under this new fiscal and monetary regime that we were experienced for the past 12 or 18 months at that point, nobody was talking about gold at all. And that was very strange to me. And I'm curious to hear your thoughts. Just like, I know there's a stigma historically about being a gold bug and all these things. Same could be applied to Bitcoin. I'm wondering if you think that stigma is starting to shift. And do you think that gold is finally kind of at a point now of getting, let's say, more institutional credibility in portfolios, or not so much?
No, it's interesting because I was at a conference probably 18 months ago, and somebody said to me, Luke, I get you. I understand what you're saying, but if I buy gold and it goes down 30%, I lose my job. And if I buy treasuries, long-term treasuries, and they go down 30%, I keep my job. And so it's super interesting because at the same time, without getting into any specifics, I'm also having conversations with people at at very high levels in finance, very recognizable names, and they love gold. They love it, and they own it big. And so there's almost like this sort of the. I mean, even like Besant, right? He's a self-admitted gold buck, right? He's now the Treasury Secretary of the United States, and yet, like most of traditional finance is still where that person who said that to me is like, look, I can't own it because if it goes down, I get fired. Whereas if I lose money in treasuries like everybody else, then I'll keep my job. And so, to me, it just speaks of being in early innings, right? It's kind of the classic, early adopter, late adopter stuff. Like the early adopters, they're partly there, but they get it, I think, and part of it is it's not a question of intelligence or of sophistication. I don't want to make you think that's the reason for it, but I do think what it is the average person in finance not only doesn't get paid to think about, but is actively discouraged from thinking about things like, what does it mean that central banks are buying all this gold and stuff? What does it mean Russian FX reserves being like the average financial person in America is like, oh, we seize Russian FX reserves. All right, yeah, hashtag America, great. And that's the extent of the thought, rather than, okay, what does this mean? What does this mean? And so the guys are going, what's this mean? What's this mean? What's this mean? Are going, oh my God, I got to buy gold. I got to buy gold. And the central bankers are going, oh my God, I got to buy gold. And sort of the people that aren't thinking about those second derivative things are like, well, just not thinking about that yet. Price is probably starting to wake them up to that, right? Americans, right or wrong, right? The average American investor won't buy anything if the price isn't moving. They'll wait till the price moves. And that's just how we are culturally. Certain cultures are value buyers. Certain cultures are momentum buyers. And Americans culturally are generally a momentum buyer. So, it's probably starting to get onto people's radars. But even then, most hedge fund prime brokerage agreements, I'm told, prohibit specifically being able to take physical delivery of gold from your prime broker. Right? By the time this cycle's over, I don't think that will be there still. That prohibition.
Yeah, that's what makes this time incredibly exciting, exhilarating, because while it's bleak out there, we know it. When we see inflation, we see the trends, demographic trends. There's this notion that, you hear Dalio come out. We were talking about it on our previous pod. I think he came out at like 5% or 15% allocation for something with gold and some smaller in BTC. He's much more allocated to that. But the inertia that exists with his investors, and we talked about this as well with the all-in guys who are pretty popular. It's like Chamath was on this trade in 2013. He doesn't talk about it because he has a whole LP base. Like, these people aren't incentivized to discuss it. In the same way, to your point, institutional investors, either by design or because they can't talk about it and really pitch it as anything viable. But in reality, on the back end, there's a bunch of people allocating. And it goes back to Saifedean in his book about you can't really insulate yourself from a harder money than others are holding. And so whether it's a sovereign or just an individual or company balance sheets, now there's the pub code craze, which we have our own opinions on, but the notion of like a company like Figma, that's just pure good business to be able to hold a harder currency. And if you're a business, if you're an individual, personal balance sheet. And you touched on something on Brelo's pod that most people don't talk about. It's something that's been instinctually in my mind because I've been in the space for a while. And you talked about the ETF and approval and how there was a little bit of, I don't want to call it weirdness, but it was a little curious in your mind on, from a, I think you know where I'm going with this, that from the U.S. and inflation and effectively the 350 million Americans need to be able to preserve, if you onshore production and inflation runs, people need to be able to hold a better form of money or they're not going to be able to buy any of the things you produce. And back in 22 and 23, this doesn't get discussed, but institutional investors wanted nothing to do with Coinbase. I talked to them. The folks at Citadel and BlackRock, they wanted nothing to do with Coinbase. It was a Web3 company. In their mind, it was the same thing as BlockFi, FTX, Celsius. And something shifted between like that summer when everything collapsed in 22 and fall, and then 23 when Coinbase was just blessed by everyone and the ETF was blessed. And the guise was thrown, and the common narrative was that the Grayscale, ETF, and it was the lawsuit, and that really did it, but it never felt right. And you're the only person I've heard kind of talk about this publicly. Do you know what I'm referring to on Brelo's podcast? Where you're discussing the ETFs getting approval.
Was I just saying that basically you got to if you're going to inflate things, really inflate things, you've got to let people hold an asset that's going to preserve or grow some purchasing power ahead of time, or else you're just going to you're going to spur a revolution, basically.
Exactly right. So in that vein, then that was the real reason, or a large component of the ETF approval, was to get consumers the ability to hold a form of money that would be able to, hold their purchasing power.
Yeah, and I'm not all in the weeds on the sort of Biden administration versus Trump administration regarding favorability towards Bitcoin. My understanding is that the Trump administration has been far more favorable, and obviously that was still during the Biden administration. But yeah, I think ultimately, I think our leaders, there really is a version of the Churchillian commentary, right? The Americans always do the right thing after they've exhausted all the alternatives. Like, I do think that's kind of a cultural phenomenon where America will ultimately do the right thing. They won't go down with the ship doing the wrong thing. And I think that might have been an example of that, where there was this belief of, hey, we can, 2022, right? We were, how many times were we hearing that Powell is going to be the next Volcker, right? He's going to fight inflation. He's going to stamp it out. And I was writing for clients at the time, in not so many words, that, people saying that are high. There's like zero chance they can do that. Like it's not, I went to public school. It's very simple math. It's impossible. He's not gonna be able to do it. It's gonna blow up. And fall of 22, it did blow up. Yellen started weakening the dollar. And so my view is that, probably sometime shortly thereafter, and if not then in probably, first half of 23, when they had to come out and save, Signature and basically, the BTFP, it's like, oh boy, here we go again. Okay, we thought we could do this. We can't do this. We're going to have to inflate. And if we're going to inflate, then if we want to avoid, the sort of, pitchforks and torch outcome, then basically, we cannot keep bondholders whole on a real basis and inflate away the people. We need to inflate away the bondholders and keep the people whole on a real basis. That's the smarter thing to do, and politically. And so I have no sort of proof of that, or I've not heard anything to suggest that there was, some decision made in that regard. I just watch the favorability shift, as you described, sort of after 23, in line with what was happening. And, I think, there were other things Yellen showed throughout that time that were very pragmatic, where she kind of said, oh, even as far as going like, oh, my whole academic dogma around neoliberalism and free trade was totally wrong. Sorry.
I would love to talk about, digging a little bit deeper into the administration, because we brought up Bessent and being a gold bug, and then Luke, you just mentioned, and Michael, about how if you're going to inflate everything away, you want to get your citizens into a better form of money or a scarce asset to preserve purchasing power so they can participate in the economy. Love to hear, Luke, your thoughts on this first 8 months or so of the Trump administration. What sticks out to you just from their economic policies, and more specifically, the embrace of Bitcoin and stablecoins as part of the bidding up the treasury market, creating demand there? Just love to hear what sticks out to you there. I'm sure Brian has thoughts as well. Brian actually sold all of his Bitcoin for stablecoins. That's how much he loves stablecoins. But Luke, what are your thoughts?
I think they have shown an ability to course correct from starting on the wrong foot, right? So, like, if it was me, and I was pretty vocal about this at the time, I would have come in and done kind of the big bath, right? I would have just said, look, the prior administration did all this. We're going to devalue the heck out of the dollar. We're going to revalue gold up. We're going to buy down debt, and we're going to go. And they did weaken the dollar over the course of the first half, of course. But like, to me, the whole Doge thing was a complete airball, and was always going to be an airball. I mean, you just look at what we spend money on. It was, maybe it's entirely possible there was a political nod there for that sort of ground ball had to get run out, whatever. I think, so from an economic standpoint, when I say they changed course, I think they wasted time with a completely flawed Doge effort that was never going to work. I think they completely overestimated their own ability and their own leverage as it relates to China specifically, but the trade war more broadly. Both vis-a-vis things like rare earths and the balance of trade, but also critically about the treasury market. They did Liberation Day, and 7 trading days later, the treasury market's blowing up. Like, that shows to me, an astonishing lack of second derivative thinking or understanding of what was going to happen. With all of that said, they have shown a real ability to, I think, change course. And I think maybe the best example of that is just sort of, cramming through this Genius Act and stablecoin thing, which is ultimately, in my view, the pace and the aggressiveness with which this was pushed through, I think, should be taken as a read on how concerned they are with the U.S. fiscal situation. In other words, they've got to find significantly repressible balance sheet. They need to find somebody willing to buy lots of bonds at near 0% now. And so I look at that and go, that makes sense. But it only really makes sense if you can get rates at the front end down. And, there is sort of 40 years of dogma in the U.S. around, hey, well, they can't cut rates if inflation is still here or unemployment is still low or what. And that's what we're living through in real time right now, which is, no, they don't. They are, why are they firing this woman? They need rates down now. And the reason they need it down is not because they hate the Fed or because Trump's an authoritarian or wants to be some dictator. It's because the U.S. fiscal situation is that bad. They need rates down to 0. They need to finance a lot more of it in the bill market. If they need to, means they need to get Bitcoin or stablecoin market cap up a bunch. And then I look at all that and go, in that world, it's hard for me to see a world where stablecoin market cap goes to 3.5 trillion over the next 2-3 years, like Besson just talked about, and Bitcoin doesn't move, right? Or goes down in price. I just don't see a world where that makes a lot of sense to me. So if not explicitly, they're kind of standing up Bitcoin in that way as a neutral reserve asset of sorts. But at the very least, they need Bitcoin up. Because if Bitcoin goes up, I think that's going to drag. We can have a chicken or egg discussion. What comes first, stablecoin or Bitcoin? I don't know. I could argue that either way to no effect or to limited effect. But ultimately, I can see the relationship, and so it's hard for me. I think it's hard for me to see a world where stablecoin market cap's up a bunch, which they absolutely need as a result of the fiscal situation, like yesterday. Without Bitcoin rising a lot. So it's suddenly in their interest for Bitcoin to be a much bigger number.
Yeah, credit to you. I think you were one of the only people calling out, at least loudly, how Doge, just the math didn't check out pre to the discussion, and most people were excited about it. It's like, this isn't going to work. One thing to call out on the stablecoin aspect that people generally don't bring up is it'll soak up demand on the banking side as well, because I think pre this Genius Act, and I think this is going to tie more to market structure. But pre-Genius Act, banks could custody the asset. They just had to have a 1-to-1 ratio in treasuries or dollars sitting next to the underlying. And so I think there's going to be something naturally that would happen like that, as well as BNY and these banks step in. They'll be able to custody the asset, but they're going to have some kind of pairing with, naturally treasuries or dollars, stable coins, which is naturally going to soak up more of that kind of demand you're talking about.
Yeah, and there's a world where, they can get euro dollars flowing out of other places into stable coins, T-bills. Again, it's easier if dollar rates are lower, but they don't have to be, because Best can just go, throw the grenade of like, hey, in the next crisis, we're not backing any of that stuff. No swap lines for anybody. Have a good day. Put it all in stable coins. And, with the yields around the world doing what they're doing, particularly in a lot of these places, we look to maybe not be that far potentially. We're a couple bad bond market days away from a crisis of sorts that might start to sort of, light that fuse. So let's see. But to me, it makes sense to do. And then we can get into economic policy around, what they're doing with some of the, whatever we want to call them, nationalizations or investments, or however we want to spin these things, these are capitalism, not socialism, or whatever we're calling it. It's I'm equally unpopular on both sides of the aisle, actually, because I try to actually call a spade a spade.
That's how you know you're onto something or crazy is if nobody agrees with you. Maybe, I don't know. We talk about that very often at our firm because we work on something called multi-institution custody, and it doesn't allow for any institutional counterparty to hold unilateral control of the asset, but the individual doesn't hold. I got one here just to always keep it, the plastic device with all the money. And we make the hardcore Bitcoiners not too excited because it's not, obviously not your keys, not your coins. But then there's obviously institutional capitals like, well, if you're BNY or Fidelity, it's like, I got to hold all the money. And this is that middle ground. And so it's something I tell the guys often when you get laughed at, you're either very crazy or you might actually know something. That would be maybe a good transition on the productivity side of things. Like, where do you see the nationalization effectively of Intel, because at the end of the day, we know government intervention ends up with inefficiencies, not efficiencies. And maybe starting there, because I have some other follow-ups, but just curious, like what your take is. It just seems like a preposterous path we're going down, but curious on what do you think?
I think it is a preposterous path, but I think it's the right path. The problem is that it's, as with the Doge stuff where they were doing the wrong order of operations, right? Like Doge would work fine if you'd have devalued the heck out of the dollar first and devalued the heck out of the debt. Then it'd have been fine. But without having done the first, it was never going to work. And I feel a little bit of the same way as it relates to some of these nationalizations, which is to say, like, we had no problem backstopping banks. And you could say, well, that was an emergency. Well, this is an emergency. Like, NATO just got its ass kicked in Ukraine. And we got its ass kicked because the U.S. military on the margin is now made in China. And we were outproduced by the Russians, a country that we used to laugh at. That's a country with a gas station attached. Yeah, well, they outproduced us 4-1, the entirety of NATO. And why? Because that's how much our industrial base is hollowed out. So, like, as much as nationalizing the banks was in 2008 was an emergency, this is an emergency. Now, with that out of the way, the challenge is that they're treating it like a narrow emergency. This is like, well, we have dollars and we can do this, and so let's do this. It's basically like we're going to out-China China without the requisite infrastructure, without the requisite electrical grid, without the requisite, like, strategic planning. Like, it's just like, well, if we own Intel and we own Lockheed Martin, then it'll be better and they'll make weapons and chips faster. And it's like, no. There's there's still an order of operations, guys. Like, you got to have a grid. Oh, by the way, for 40 years, you've been telling people, like, go into finance because engineering sucks and it's hard and you're never going to make any money. And, oh, by the way, if you go into the skilled trades, you're useless. Well, 40 years later, we are now woefully short welders, skilled tradesmen, engineers. And so if we're going to nationalize some of these critical industries, which I think is on some level the right thing to do to get some money directed into them, you still have to do the uncomfortable part, which is you got to direct some money into these trades. All of us need to get out of finance and go weld, because we can make $1.2 million a year welding and we don't have to think about our jobs when we go home. And we're not worried about what Trump's going to tweet at 9:00 that night. We don't give a shit. We're watching Monday Night Football. So and now the tricky part with that is the bond market blows up. If they want to nationalize companies to reshore industry, they don't have the long-term plan. They don't have the infrastructure, in terms of grid, et cetera. They don't have the welders. They don't have the engineers. And making matters worse, in the next 5 to 8 years, a quorum of the engineers and welders in this country are going to age out. So then we won't have them at all. And now you're, kicking labor out. Not going to talk politics of it. I can just tell you, you're going to, a lot of this labor, you're not going to be able to make welders in 5 years anyway, because they don't even speak the language, right? So you're not going to be able to turn someone who doesn't speak English into, an engineer in 5 years, probably, or 3 years, say, right? So maybe 5 years you could, but not in 3. So But at the same time, that removal of labor is also going to put upward pressure on wages. And again, it gets back to this elephant in the room, which is trying to do all of this without just taking your medicine as it relates to the bond market. It's not going to work. Like, you basically, the thing we should do first is just blow up the bond market. Like, just blow it up. Revalue, like, and I'm not saying get rid of it, but I'm just saying devalue the currency enough so that it is no longer like making the decisions. Because right now it's making decisions for us. We can't grow too fast. Why? The bond market. We can't hire too many people. Why? The bond market. We can't, subsidize welders and engineers. Why? The bond market. We can't do this with growth initiatives. Why? The bond market. Get rid of it. Like, we would never, how many times have you guys heard we're in a great power competition, or even amongst the more hawkish, we're at war with China? Great. Show me in 1941, 42, 43, where FDR said, I'm going to make bullets and tanks and ships and jets to fight the Nazis if the bond market will let me. It never happened. It never happened. And I think part of that is what we're seeing. I think that's where we're going. But it's one of these things where you don't want to say it. I can say it, and people say, oh, Luke's crazy. I think Luke's going to be right, but Luke's crazy, right? That's fine. I'm a crazy guy in Cleveland. I can say this. You can't say this if you're Scott Bessent. You can't say it if you're Stephen Meyer. And you can't say it if you're Donald Trump. But I think that's what they're going to do, right? Like, when we really look at what this whole Fed thing is about, this is about subjugating the Fed. Get them out of the way. They don't get a say in this. If we're in a great power competition, they have one job: buy every bond we issue at 3/8 at the front end and 2.5 at the 10-year, like they did during World War II. That's it. And bonds get killed on a real basis.
Yeah, I mean, from a first principle perspective, the Intel, it's effectively a distortion of capital markets, but also, to your point, of incentives, right? Because you referenced earlier in TradFi and individuals in finance, they're looking at their benchmark in bonds. They're not going to get fired. But if you blow that up, it realigns the incentive, which ties back to, it was a tweet you had retweeted. It was somebody paraphrasing that they were like, I think they were in defense manufacturing or some hard skill, and they were trying to raise venture capital. And the venture capitalist told them to go to the PE firm. The PE firm told them, like, you're not Musk, and to go to the VC firm. And it's that just basic like concept of nobody's incentivized to do anything productive in this world because the underlying unit is fundamentally flawed. And that's what's, I guess, not exciting, but gives at least somebody, younger, or I think everyone, hope that if we get back to like the sound renaissance that I think we're upon when it comes to gold and Bitcoin, and people just understanding money doesn't grow on trees, well, the free market will ultimately bring in those plumbers and the welders. When people, if they say, pay me in gold or Bitcoin, or I'm not going to produce it, and then they'll demand their market rate. I think we end up there. Now, if it's 2 years or 20 years, that's TBD, but that's where the market goes because people just will want the better money. So, yeah.
No, I think that's right. I mean, and I think you're seeing, someone asked me that the other day on a podcast or somewhere. They said, well, it's not fair if Bitcoin goes to 1 million, then it's going to be the Bitcoin or some narrow subset that gets rich, and everybody else. I'm like, yeah, but look at the Bitcoiners. They are net producers that understand money. What do you think Bitcoiners are going to do when Bitcoin goes to 1 million or whatever the number ultimately? They're going to turn around. They're going to buy and invest in an HVAC business. You Google up like I think it's like biz sell buy or something like that. You can find people selling these small businesses. The internal rates of return on these things are insane right now. Insane. Like, you can buy, a business, an HVAC service business. It's like for $650,000, and you're going to make $250 a year. Like, and no one wants to touch it because it's like there's an artificial obstacle there. There's nobody going to trade school, so they wouldn't know what to do with it. So it's this fascinating thing. But at the right number for Bitcoin, at the right, you would start to do it. Now, like you said, time TBD, and what does that look like? Because we don't, the interest doesn't sleep, and it's growing really fast at 5%. And, at the same time, some of the entitlement stuff's growing really fast, and, we may not have that. So that ultimately, to your point, like, the free market will work. It's just a question of, Bitcoin will force that free market to work, and then Bitcoiners will, sort of pick up the pieces and rebuild things, and away we go.
Yeah, I know Jackson has some thoughts, but one last thing to share. There's so Texas, obviously, or not obviously, but had approved the strategic Bitcoin reserve, and we're talking with them and others around custody, and ended up in without killing any confidence in a very high level room in Texas. Working for the governor when it comes to just everything related to accounting for the state of Texas and GDP, and what came up was like, how do we tax this thing and how do we just measure it and all that. I was like, okay, look, that's important, but that's like incremental, very small, receipts as compared to just make this favorable for people to come and build businesses and work. And you've already kind of seen this because to your point, this is something the UAE's really like figured out from not only the tax environment, but they've been mining. It's like you want that within your borders because naturally, to your point, it's very first principle. Like people don't hoard money just to hoard it. They have certain things they want, whether it's just personal goods and services that they want to live lavishly and then that'll reinvest, or they're naturally going to reinvest in productive goods and services. And you want that within your sovereign borders if you want your citizens to thrive. And I think people are slowly waking up to that. And that's kind of positive in kind of the structure of the states where you have that competition happening here.
It's fascinating because money's been so distorted for so long that everybody kind of has it upside down, which is to say, think about OPEC exists. It's a cartel, right? And why does OPEC exist? It exists to restrict the output of oil in order to maximize dollars. Why do they have to do that? Because the dollar's a fiat currency that is, you have to do that. If OPEC was selling for gold, or if OPEC was selling for Bitcoin, there would be no need for OPEC because every producer would be incented to run oil production full out all the time to get as much gold and Bitcoin as they could today because it was a finite, harder money. And as a result, you would have a deflationary, highly productive, and every business around the world would have that same incentive. Maximize output and productivity today. I'm going to invest to improve productivity because I'm competing for a harder money. You end up with this wonderful world, this high growth, low inflation, highly productive world just by changing the incentive like that with the money. But it's like if you ask a fish, its environment, the various thing it would describe would be the water.
It's so funny you bring that up because that's something some of the highest gigabrains on the engineering side of Bitcoin have referred to as the Nakamoto point, that eventually when you play this out, 50% of all production will go to mining.
Was that right?
The other 50%. It's actually a book. You probably read it where it came from, The Prize, which effectively breaks down kind of like oil production. You can kind of...
Oh, I've not read it, but I know of that one.
Yeah, and it basically, I think, stems from that all you can look at geopolitical conflict exist around oil production and how do you have to transfer it for dollars. But if you have a neutral asset, you can literally mine it directly to the decision point is either directly to the asset or to the consumer good. And that just creates an equilibrium that we've effectively never seen.
We've never, because it's just all, humans are flawed, basically. And, greed, fear.
All right, so just the other week, my coworkers, I think it was Michael or Brian, told me it looks like I'm recording from my grandmother's attic, and that really hit home. And I really do want to be able to upgrade my podcast studio, but in order to do so, I'm going to need you to like the video and subscribe and comment. We just need to get the word out there. Let's help to get this episode with Luke out to more people. So if you can just help us with the algorithm here, if you can subscribe to the channel, leave a like, leave a comment. I really appreciate it. Hopefully I'll be able to upgrade my camera, my audio, and by no time I'll be a professional podcaster. And so please do it. It just takes a few seconds. We're spending time every week. We are booking guests. We are preparing for the episode. We are sitting down, editing, distributing, you name it. And so it's a long process, but it's a worthwhile one. And I would love if I don't need to get picked on by my boss anymore. So yeah, please leave a like and a comment, and hope you enjoy the rest of the show. So yeah, on this topic of just where this is all heading, my question is, how weird does it get? And what I mean by that is, so Luke, we've discussed a lot of the underpinnings of where we are today, the discrepancy between labor and capital, and learn to code is now learn to weld. And I'm just curious, where does this all go, right? Because now we're under crazy deflationary force with AI. Probably a year from now, I won't have a job anymore because I'm just going to automate myself out of one. And how do we reconcile the $37 trillion of debt with more and more compounding at crazy rates. So how do we, inflationary system that is just exponentially growing, how is this going to end with AI just eating everyone's jobs?
Yeah, well, how weird's it going to get? I think it's going to get pretty weird. And I don't know, you know, ultimately, I keep harping on, as it relates to AI, like most of AI is way over my pay grade. Other than this, I can tell you with absolute certainty if AI does even a fraction of what a lot of people think it could, it's fundamentally incompatible with our debt-based monetary system. Like, I've seen this happen already. Like, I have an advantage being in Cleveland, being in the Rust Belt. People are like, oh, the productivity would be great. I'm like, for some, like, let me tell you how this went the last time we had an AI productivity miracle. It was called Chinese. It was called China. It was called take all the manufacturing and move it to China. And it was great for the corporate execs. It was great for their stock options. It was not so great for the working and middle class. It was, they who had, their $30 an hour job at GM with full benefits, knocked to $12 an hour as a Walmart greeter, no benefits. But for a period of time there, from like 02, 03 to like 07, 08, it was fine because they got a subprime mortgage or a subprime home equity line. And so they still got the bass boat, they still got the truck, they still got, the vacation. Their standard of living didn't fall immediately with their actual standard of living. It hadn't been mark to market yet. And then home prices stopped rising. And then everybody couldn't refi all those lines. And it all came unhinged. And we know how it ended up, which is the Fed's balance sheet went from $800 billion to $4.5 trillion over the next 4 years. Okay. That's the model. And, that's the model, which is massive productivity gain. Okay, are we going to get some sort of subprime lending to paper over, white? I mean, it struck me the other day. I mean, you guys saw if you read my work, like New York Times had a map showing in 38 of the 50 biggest U.S. states, the biggest employer is healthcare. And that's not docs and nurses. That's mostly administrators. That's mainly paper pushers. That's stuff that like AI is uniquely, suited to disintermediate. And those people all have mortgages. They all have car loans. Student loans not so big. That's just defaulting on the government. But you actually can't default those. But that's neither here nor there. But like we saw this before, where when they stop paying on the mortgages, when the mortgages start getting delinquent, then what? Where's that show up? Are we going to bail out the banks again? So you can see very quickly the path is loss of jobs on the margin. It doesn't have to be a lot, but just wage deflation, loss of jobs. You start to see some consumer credit defaults. Do we get some sort of, it would have to probably be universal basic income, because I don't think there's any subprime that's going to be coming up to really paper over any of that. Maybe we're seeing some of that with the the buy now pay later on friggin' burritos. Maybe some of the growth of that industry is this version of subprime. That certainly could be the case. But ultimately, we know, you're not going to be able to refi a burrito more than a couple of times. And ultimately, the debt-based monetary system doesn't work with what AI is going to do. And therefore, they're going to have to backstop this. They're going to have to backstop the whole system. I was talking with Jeff Booth, and I'm sure you guys all either know Jeff or know of Jeff. He has the great book, The Price of Tomorrow. And he and I talked about it first time we met in person, and we were talking about it at a conference, and people are like, well, what's going to happen if you've got, all this debt that's growing exponentially and technology is getting exponentially deflationary? Well, how's it going to work out? And he looks at me, I go, they're going to have to fully reserve the debt. He goes, they're going to have to fully reserve the debt, i.e. 150 trillion in debt, whatever that's consumer and sovereign, I don't know, 80 trillion, 100 trillion. It's all going to end up on a central bank somewhere, central bank balance sheet somewhere, printed. And those dollars will be printed to fully reserve the debt. And so to me, most of AI, I know is above my pay grade, but if it does what even close to what some people think it could, many people think it could, to me, you got to own Bitcoin and gold. You have to, because basically they're going to have to fully reserve much of the debt to prevent it from blowing up the entire system as a result of the deflation driven by AI.
Yeah. And I would go as far as even to say, if you one of the data points you shared earlier this week, Luke, was just on the birth rates in the U.S. hitting all-time lows, right? If you want to own a home or you want to start a family, you need to own gold and Bitcoin as well. And so, yeah, it is going to get weird. And I don't think any of us have a crystal ball, but it truly is unprecedented times. And so I like to think, at least, even though I'm not out there welding and producing anything with my hands, hopefully this podcast makes it to some people who, can share it with the friends or family so they can start to peel back layers of the onion, get a better understanding of what's actually going on here, because it is critical. And, we like to pick on the boomers all the time, and maybe in some part for good reason, but I also have some level of concern for the boomers, maybe not the ultra wealthy boomers, but model portfolios tell you to own bonds, right? And we've made an entire case this podcast why that may not be the best idea if you're living through a 1 in 100 year global monetary reset. And so I not only have concern for people of my generation, millennials and Gen Z, but also on the other side of the barbell, a lot of, there is going to be a lot of wealth that's destroyed if you're not properly allocated. So, I really appreciate the work that you're doing.
No, I appreciate it. Yeah, and I think that's exactly right. I mean, it's one of these things too, where for the average investor, it's put 10, 20% of your net worth into gold and Bitcoin based on, volatility adjusted, right? With what you're comfortable with. And then go live your life. It's not one of these things you need to be monitoring every day. And it's not a huge fix, right? It's not in a country that really, really loves okay, just give me the pill and I'll do it, doc. The pill is simple. The financial pill is simple. It's 10, 20% in gold and Bitcoin, volatility adjusted based on what you prefer, and go live your life.
All I was going to say is that the gold and Bitcoin, the trades are going to persist much longer than everyone expects, or maybe forever. You hit on it earlier, Luke, about having a big position in gold and then naturally moving a little bit into BTC. I remember in 2020, when COVID happened, I was all in Bitcoin. I've been all in Bitcoin for a while, but I naturally shaved some off for gold. It was if this thing is real, this is pre kind of finding out whatever COVID was. It's you're just going to want something physical. And I've been thinking about that more recently, because I'd encourage anybody listening, because there's a certain segment of the market that is all in or very heavily skewed towards Bitcoin. And I ended up randomly watching Cinderella Man. And it's a movie about a boxer or whatever, but it's really actually a movie about the Great Depression. And I think we naturally forgot about what happens in a Great Depression and how you get wiped out, and you're not going to be able to eat your Bitcoin. You may be able to use it, but you may want a little bit of gold just in case. And I don't think we see this with very significant holders. I'm talking people holding $100 million plus in BTC. They'll naturally cycle out a position into gold for a number of reasons. It's just the prudent thing to do. And I think the opposite is also going to happen as gold runs and people have been the gold bugs. They're going to naturally diversify into BTC for a number of reasons. And I think that's still an early kind of theme that both those camps have been in separate territories, and they naturally are going to have to converge because that plumbing is also in the works as well.
Yeah, I think that's fair.
Yeah. Well, Luke, appreciative of your time. We didn't get to cover the rare earths, but we'll point people to your X feed because I want to be respectful of your time. So if you want to learn more about what happened this week, check out Luke's work. But thanks again, Luke. Really do enjoy your work. Encourage people to read your research. If people are not following you already, where's the best place to get in touch?
Yeah, they can learn more about our institutional and mass market research at fft-llc.com. And as you guys noted on X, at Luke Gromen, all one word.
All right. Thanks, Luke.
Awesome.
Thank you guys for having me on.
Thanks, Luke.
Appreciate
Enjoyed
it. Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that OnRamp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.